Hello financial fans, welcome back to another stock analysis. Today we'll be covering Procter Gamble, stock ticker PG. Procter Gamble is an American multinational consumer good company that was founded in 1837. The company operates in several categories including beauty and grooming, healthcare, fabric care and home care, and baby care among others. Some of the well-known brands owned by Procter Gamble are Tide, Crest, Pampers, Olay, among others. Procter Gamble is committed to delivering products that improve people's lives and makes a positive impact on the world. The company is a leader in sustainability with a focus on reducing waste, conserving energy, and sourcing materials responsibly. With operations in over 70 countries and a portfolio of trusted and well-loved brands, Procter Gamble is one of the largest and most successful consumer goods companies in the world. They're currently sitting at a $327.9 billion market cap. In 2021, they generated a revenue of $80.2 billion. Dividend yield is currently sitting at 2.61%. 18% of their revenue is generated from the beauty section, 1% from corporate, 35% from fabric and home care, 8% from grooming, 13% healthcare, and 25% baby, feminine, and family care products. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company. I will be using a standard margin of safety of 25% that can never be below 0%. Margin of safety can either increase or decrease by the ratios that we're going to look at in just a moment, and the severity that the margin of safety will change by will be determined by using a scale. When we're using 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from a margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction from a margin of safety. First two metrics that we're going to be looking at are the EBIT growth and the margin growth. The EBIT has gone up over the years, going from $14.1 billion in 2013 to $18.7 billion in 2022. The average growth in EBIT during this period was 3.4%, which is no change in the margin of safety. Margin, however, has also grown, growing from 17.6% in 2013 to 23.3% in 2022, which is 3.3% average margin growth, 5% deduction from a margin of safety. Next two ratios are the dividend growth and the payout ratio. Dividends have also gone up, going from $2.10 a share annually in 2011 $3.65 a share annually in 2022. The average growth in dividends per year during this period was 5.2%, meaning no change in the margin of safety. While the payout ratio is still sitting at a nice 63.4%, meaning there's still room for dividend increases. But no change in the margin of safety, since it's not quite as low yet. Final two ratios that we're going to look at are the debt to EBITDA and the return on invested capital. To get our debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debts. For Procter & Gamble, this is just over 1 year, in this case a 117% debt to EBITDA ratio, which is very nice, and a 5% deduction from a margin of safety. Also, the return on invested capital is looking very good, which is sitting at 13.1%, meaning another 5% deduction from a margin of safety. So far, it's looking pretty good for Procter & Gamble. Let's go look at the valuation models next to determine the intrinsic value. First valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow going from 2013 to 2022. Procter & Gamble had an average growth in free cash flow during this period of 3.75%, and I'm projecting an expected growth rate in the free cash flow over the next 10 years of 3% annually. With this percentage, we can determine the future free cash flow of Procter & Gamble and determine the terminal year of valuation, using a perpetual growth rate of 2.5% and a discount rate of 8%. This leaves us with a sum of free cash flow of $251.8 billion, and to get an equity value, we have to add the cash and equivalents and subtract the debt, leaving us with an equity value of $226.8 billion. And to get a discounted cash flow price per share, we just have to divide it by the amount of shares outstanding, leaving us with a price of $96.11, which is almost a 31.3% downside out of this model. Second model that we'll be using is the dividend discount model. I've imported the dividend payouts going from 4 years ago to the current year. The average growth rate in dividends during this period was 6.25%, and I'm projecting an expected growth rate in dividends for Procter Gamble of 5.5%. We'll once again be using a discount rate of 8% in this calculation, and this leaves us with a price per share of $154.17, which is a 10.10% upside from the current price. The third valuation model that we'll be using is Graham's revised valuation formula. In this valuation model, we'll be looking at the earnings per share that Procter & Gamble is generating, growth rate estimate made by Wall Street, and the current yield of AAA corporate bonds. And we're going by the PE of a company with no growth of 7. Out of this model, we get a fair value of $69.99, which is almost exactly a 50% downside from here, out of this model. Fourth model that we'll be using is the multiple valuation. In this model, we'll be looking at similar companies to Procter & Gamble, look at their stock price and earnings per share to determine the average PE multiple in the industry, which in this case is 33.97. All that we have to do to get our fair value is to multiply by the earnings per share that Procter & Gamble is generating, which is $5.70 a share, leaving us with a fair value of $193.61, which is a 38.27% upside from here. And the last model that we'll be using is the mean reversion theory. This model, we go by the theory that a company is always trading above or below its mean, and the metrics that we use to determine this is the dividend yield and the PE ratio. I've imported the dividend yields from the past 5 years, which was an average yield during this period of 2.61%. The current yield is 2.58%, meaning that it's slightly, just by a little bit, overvalued from this metric, but we'll also be looking at the PE ratio, which I've also imported. The average PE multiple during this period, from the last 5 years that is, was 29.19, and the current PE ratio is 24.56, which is slightly undervalued looking at this metric. This leaves us with a fair value that is higher than the current price, which is $152.31, which is almost 9% higher than the current price. Let's go look at the final overview of our valuation models next. Looking at our final overview, we've imported discounted cash flow, discounted dividend, Graham's valuation, the multiple valuation, and the mean reversion theory prices per share, leaving us with an average of $133.24. Without a margin of safety, our downside would be 4.85%, but we have determined our margin of safety earlier, using a standard margin of safety of 25%, deducting it by 5% for the debt to EBITDA, another 5% for the margin growth, and another 5% for the return on invested capital, leaving us with a margin of safety of 10%. Applying this margin of safety, we get a fair value of $119.91. At the current price of $140.02, this leaves us with a downside of 14.36%. If there's any other companies that you would like to see me cover in this channel, please let me know in the comments. And thanks for watching.